good?
Yeah.
Okay. I won't tell everyone who's watching the videotape what you missed in terms of the delicious pizza or the brownies and things like that, but next time you guys want to be here. All right? All right, so right before the telephone rang, we were talking about Baker v. Commissioner, and we were talking about the shortcomings of the IRS. Why was the IRS so fundamentally wrong here? Is they treated the losses, or they treated, excuse me, the trust as if it were a pass-through entity. And it's just not true. So if this loss, that the partnership loss was originally $7,000, and afterwards it was $2,000, okay? So it went from $7,000 to $2,000. So notice there's a $5,000 disallowance amount. Okay, I'm oversimplifying, but that's the takeaway. Assuming that to be the case, guys, what is the effect, as analyzed by the court, what should that have done as a tax, what was the tax implication associated with this loss disallowance? What was the tax implication associated with this now loss disallowance? And what you should realize is what happens to D&I if a loss is disallowed. What do you think happens to D&I? Even if you didn't read the case, make it up. What do you think? It goes up, right? Because D&I, the starting point for D&I is taxable income. Everyone agree? And if a loss is disallowed, hint, hint, that means that's going to increase, that loss was sheltering otherwise taxable income, so D&I is going to go up by $5,000, right? And if D&I goes up by $5,000, what's apt to happen to the beneficiary who had gotten a distribution during the year? The larger the D&I, the larger the deduction at the trust level, but the more that's going to be included in the beneficiary's income. Everyone agree? That if you increase D&I because there's a greater loss disallowance, that means D&I is going to go up. And if there's a distribution, that means that there's a greater dollar amount taxable in the hands of the beneficiaries. And here, David, to get to a point you were raising, that originally the trustee said, oh, we're distributing capital gain to the beneficiary. Well, you don't get to choose, right, what you're distributing to a beneficiary. In other words, whatever the income earned by the trust, the D&I will be comprised of a pro rata share of each kind of income earned by the trust. And it may have capital gains, it may not. So it's going to be dictated by the nature of the income earned by the trust. So the Baker case, if anything, if it gives you comfort, it should be comfort that the IRS, just like the taxpayer, got this case so wrong that the court really had to do some cleaning up here, okay? The court had to do some cleaning up. You guys can read the case for yourself. It is not one of the harder cases to read. It is not, I think it's actually a nice overview of D&I. It has references to simple and complex trusts, which we're going to look into in more detail. But I would invite you to look at page 129, 130, the footnote 8 at the bottom, because we're going to see this on several different occasions of not only how numerically D&I is computed, but to figure out how expenses are allocated to items of D&I. And what you'll see is that D&I expenses can be allocated to that income which generates the most or the largest tax burden. Here, the interest income, and therefore on page 130, the expenses allocated to the interest income, you had the direct expense, but the trustee expense and the partnership losses. And you guys can go through that at your leisure. So I'll just call that to your attention that D&I, we're going to go through several problems very similar to this, but you may want to look back at this at some point just as a refresher. So again, what is the takeaway for the Baker case? The takeaway is, one, losses are not distributed. Okay, they're not, a trust or an estate is not treated as a pass-through entity. Two, that 642H does permit losses to be passed through, but only in the year of termination. Three, it goes through how to compute D&I and what the concept of D&I means. And what impact it will have for character determinations. Now, bear in mind, and you may find this interesting, is that capital gains here were part of D&I. That's not always the case, right? Often capital gains are not part of D&I, but for whatever reason in this particular context, and there is no objection by the IRS or the taxpayer, D&I did include capital gains. And I just want to point out to you, EK, that if capital gains are part of D&I, then when you do the manufacturer's Hanover fraction, the numerator and denominator, capital gains will be part of the denominator, okay? Think about that. That if you exclude capital gains from D&I, it's not part of the denominator. If you include capital gains, it is part of the denominator for D&I purposes. And EK, if that isn't making much sense, one of the problems that we're going to be looking at in 15, 20 minutes will help illustrate that point. So by changing the amount of D&I, the taxpayer here ultimately is going to be taxable on a higher number. Keep in mind the taxpayer here received $50,000 of cash, but was only taxable on approximately $48,000. Why would the taxpayer who received $50,000 of cash only be taxed on $48,000?
Tax exempt.
D&I was $48,000. That was the maximum. In other words, you can never be taxed, right, on a dollar amount in excess of D&I. D&I is the ceiling. So what was the other 2,000? Alicia? There wasn't a loss. In other words, you get 50,000. Alicia gets $50,000 distribution. Everyone get the visual? And we know she's going to be taxed on $48,000. What is the other 2,000? What would you call that, Alicia? Give me the right name.
Still retain interest.
It's not tax exempt interest. What is it?
Interest.
It's interest?
No, interest. I mean, not D&I.
It's not D&I. What do you call it? Give me a name.
Capital.
Principal.
Principal.
Called principal, right? Everyone, again, lingo is important here, right? Lingo is important. And what that means is, very similar that if I gave Alicia as the trustee $50,000 and she gets this $2,000, if you guys, this brings you back to your income tax days, that's akin to getting 102A, right? She's getting principal. Like, that's a distribution of after-tax money to her, right?
So D&I sets the ceiling, and
absolutely.
And distributions above D&I, you can consider it a return of capital.
Yep.
Or
really like a gift, 102A.
Principal.
Because the decedent or whoever set up the trust made a contribution to it, right? And when it inures, the actual contribution itself, it should not be taxable, right? But the income on it,
should be.
And this is shorthand, the income on that contribution to the trust should be taxable. Why? 102B. But 102B gets kind of messy in this context of a trust or an estate, and that's where we need the concept of D&I to be the gatekeeper. So D&I, or Code Section 643, is really an extension of 102B. You can think of it as like an augmentation to the code, to a necessary augmentation to the code for purposes of trusts and estates. All right? So everyone's got that? That's an important concept that I'm trying to drill home with Alicia, that the amount above D&I is not, right, it's not interest, it's not tax-exempt interest, it's not necessarily, I forget the phraseology you were saying before me, whatever you're saying, it's principle. That's the term that you would want to, you would want to use if you were in the cocktail party, right? And there's this Schaefer case. We just have an excerpt on page 130. Not a hard case to read, guys. Not a hard case. Here's a challenge, and I think you know the answer even if you didn't read the case. When computing D&I, does state law or federal law control? What do you think? Federal, right? We're looking at the Internal Revenue Code, right? We need uniformity between and among the 50 states. If state law controlled what constituted D&I, taxpayers would strategically try to plant money in maybe states that yielded better tax outcomes. Can't have that. All right, so this case points out, says even if the taxpayer petitioner's argument under state law is correct, it is irrelevant. State law creates legal rights, legal interests and rights, but the federal revenue law designate what legal interests or rights so created will be taxed. So it's just, again, guys, standing for a simple proposition. We're going to be looking at federal. We're not going to be looking at state law. Chris v. U.S. Chris v. U.S. Here, just by way of background, and this may ring a familiarity, where someone creates, for the benefit of their daughter, a lifetime trust, creates a lifetime trust for the daughter's benefit, and then the property has to vest within 21 years of her death. Sound familiar? Why did the person set up this trust?
Used to be like this, the law, that they had to, the trust must terminate?
Well, remember, at the time, there was something called the rule against perpetuities, right? That property had to vest within a life and being in 21 years, right? That rule is no longer in effect in most states. But many people set up trusts for their children's lifetime, and then when their children got older, it had to vest essentially with a grandchild.
Generations.
But it avoided tax at the child's level. Avoided tax. It was the child had no indicia of ownership of the trust, so it avoided inclusion. All right. So why did someone set this up? Do you guys recall those? Maybe you did or didn't read the case. How old was the daughter when this trust was set up? 12 years old. Okay? Do you think the parents, if you're a parent and you're setting up this trust, are you setting it up, and her name is Carolyn, the daughter, are you setting this trust with primarily Carolyn in mind, or are you thinking about Carolyn's offspring, meaning your grandchildren? What do you think is foremost in your mind? Carolyn, right? Because your grandchildren to be are imaginary, right? So you're not thinking, you're setting this, so, I mean, if Carolyn were in her 30s, 40s, or 50s, and the grandchildren were teenagers or in their 20s, you might think the grandparents were thinking maybe about the grandchildren, but in this context, certainly the parent's foremost concern is their daughter. Agreed? And that's important in how this case comes out. These were obviously very wealthy parents. And they set up a trust. I say that just because the dollar stakes here, given the year involved, this is some pretty serious money here. They set up this trust for her benefit. And the question is, should capital gains in this context be considered D&I or not? Should capital gains be considered or included in the trust D&I or not? The IRS takes the position that the D&I does not include capital gains. And if the D&I does not include capital gains, who gets taxed on the capital gains? If the D&I does not include capital gains, who gets taxed on the capital gains?
Trust.
The trust. Okay, everyone agree? If the D&I does not include the capital gains, that means the capital gains are inuring to the benefit of the trust or estate. The taxpayer says the capital gains should be part of D&I. And here the taxpayer, namely the trust, contends that they were allocated to income, the capital gains were allocated to income, and again, should be considered D&I. And if they're considered part of D&I, they'll be taxable to the beneficiary. Everyone agree? Assuming there's distributions, and here there were distributions made. Now, in this trust, just so you know, the trustee was only supposed to distribute income. Okay, let me repeat that. The trust was only supposed to distribute income. In fact, there's a clause in the trust that says the trust corpus of the trust estate shall never be diminished through distribution to the beneficiary. In other words, Solid is the trustee, Alicia is going to play the role of Carolyn. When I make distributions to Alicia, as my daughter, she's never supposed to get any principal, okay, or corpus. That's what the trust actually says. It does say, Solid as trustee, I have discretion to distribute. The phrase is net profits to Alicia, okay? I have the ability to distribute net profits to Alicia. And the question is whether the income or the gains the trust earns, whether the income the trust earns constitute net profits. Now, here's the issue. The trust is going to invest in what? The trust is going to invest in a partnership, okay? The trust is going to invest in a partnership. And guess what the partnership invests in? It buys and sells securities, okay? Buys and sells securities. And that generates profits. Everyone get the visual? It doesn't invest in the securities directly. If it did, everyone agreed that, let's pick Apple stock, that if the partnership, if the trust invests in Apple stock at $100 and sells it for $1,000, there's a $900 gain. Would you call that a capital gain? Would you call it net profits, like a business net profits? And we would all say, I think, that if the trust directly invested in Apple and it recognized $900 worth of income, then we would call that capital gains. Okay? It would not be part of income, it would be corpus. It would be principal. Agreed? Conversely, and this is the essence of this case, the partnership invests, among other things, in Apple stock, recognizes a gain of $900, and on the K1 reflects that $900 as net profit from the partnership.
It's like box one instead of.
I'm sorry?
Box one on K1.
Yeah, box 1. And the question is, should the partnership's profits be considered income or corpus? Everyone agree? Should the profits that are generated by the partnership, should that be considered?
The partnership is solely owned by the trust?
No, I'm assuming there's multiple people. I'm not assuming. The partnership is owned by multiple people. Yeah, it's not just a wholly owned single member LLC, because then I think it becomes moot.
Right.
All right, the partnership is owned by, let's say, 100 other people. And I'm 99.9% sure I'm right about that. Okay? So what does the court do in examining this issue? Well, first thing it does, it turns to dictionaries. Okay? Some of you have taken tax courses before, and it's not unusual for courts to turn to dictionaries and look up what do terms of art mean. And this discussion begins on page 135, because it looks at the terms of net profits and net earnings that's used in the trust, and tries to examine, under a dictionary definition, would net profits or net earnings include partnership net profits and net earnings? And it concludes that it would. It concludes that it would. And aside from dictionaries, okay, it then turns to Texas law, turns to state law. And under state law, under the Principal and Income Act, when you own something indirectly, in this case, a pass-through conduit entity, it takes what otherwise might be principal and transforms it possibly into income. In other words, under Texas state law, that those earnings of the partnership can be considered income. And the governing instrument, the trust itself, suggests that these kind of earnings earned by a partnership can be considered income. So without belaboring the issue, it takes the court 6 or 7 or 8 pages to get to this position. It feels that the trustees were reasonable in taking the position that the gains earned by the partnership really constituted net profits in the hands of the trust, and as such, they could constitute income. And when they were distributed, as such, the D&I consisted of capital gains. Okay, I'll repeat. The takeaway from this case is that the capital gains were considered part of D&I. And I'm assuming under this case was decided over 20 years ago, and those regulations were that I asked you to look at are more recent vintage. But I'm sure if they did this practice regularly, this would never have been a court case. In other words, if the trustee regularly treated this as part under the new they're not so new anymore. The regulations with those examples are about, I forget the year they came into being, about 10, 15 years ago. This would not be a court case anymore, all right? As long as the taxpayer were consistent, because as David would tell us, there's not going to be much leakage here, right? It's going to be taxable either to the taxpayer or the trust, right? And as long as there's consistency, some years the IRS might win, some years the taxpayer might win, but overall, there should be, the outcome should be okay. Like there's not much room for gains. Go ahead.
So the partnership invests in securities,
Right.
and pass through, and the trust gets a K1, right? Which
Yep.
is, the character of that would be
Capital
capital gains or losses. In this respect, capital gains.
Right.
And then the and then the distribution of the capital gain, the income from the year is.
It's gonna be considered carry out to the beneficiary.
So it's gonna
Pull out.
make a distribution.
Because the
out to-
D&I is gonna consider capital gains,
The D&I will consist of capital gains because that'll be in the
K1.
numerator, right, well, it'll be in the K1. You've added the capital gains to the numerator.
I don't know what you mean by the numerator. Remember, manufacturer's handover
I'm
rule is to
thinking
figure
about
out the
manufa-
loss disallowance, and the numerator is tax exempt income.
Right, okay.
It ultimately, in this case, would be in the denominator if this trust in addition earned tax exempt income.
Right, okay.
So
Got me?
why, sorry. My question is, why again was capital gains part of D&I here?
Because it was considered distributed out.
Oh, okay.
And if you look at code section 643, if you distribute out capital gains, it is part of D&I. And the clearest example of that, V,
Mm-hmm.
is in the year of termination, when you distribute it out, like you sell Apple stock and you have a gain of $900, and it's the year of termination, who's gonna pay the tax? The trust has no more money.
Right.
So D&I always will be considered, to get to Alicia's point, a complex trust in the year of termination. And that makes sense because then, you know, who's the right party to pay the tax? The party with liquidity.
If, like the K1, if we, pass through, have a profit, whether the partnership has the profit,
Right.
so that can consider the profit include the income, the income
The profit
include,
increases D&I, assuming it's gonna be passed in. It's gonna
include like kind of different income.
include what, I'm
Like the
sorry?
capital one, not me, the capital gain,
Right.
or the other than capital gain. It, create the profit from the,
Okay, I'm
the
not sure, I
partnership.
agree with you, it increases the profit, but what's your conclusion or what's your question?
the question is since, the partnership has profit, generate profit, so that, can consider is a income as a, like the D&I, it can be distributed to
Right.
beneficiary.
I agree. Was that an observation or a question?
I just ask, so like this, once the partnership has a profit,
Right.
so can
It
be
will
considered
increase
the
D&I, right?
distribution.
Well, keep in mind when partnerships, and you guys don't know this, or maybe some of you do, when partnerships make distributions, generally that doesn't dictate if it's taxable or not. In other words, when a partnership earns income, you pick it up even if there's no distribution. When there's a distribution, it generally, as long as you have sufficient outside, it's not taxable. So let's just keep it simple tonight. I'm not going to ask any questions about partnership tax per se, because you guys have enough in this course to handle subchapter J, not subchapter K. So to answer your question, if the partnership earns income, that's going to increase D&I. And if it's distributed out, that's going to increase the taxable income to the beneficiaries, and it's going to include a component. It's going to include capital gains. Hold that thought. We're going to think about it, and we're going to look at some simpler problems, okay?
Can I ask
Sure.
one quick one? Is the fact that this is the partnership deals in securities is irrelevant. If it were a real estate partnership, it'd be this
Same thing.
same thing. Okay.
Okay? So, there's a revenue on, beginning on page 140, 68-392. The trustee was directed to pay an annuity of $24,000 a year to a beneficiary, or $24. It had $10 worth of income. And it's always going to distribute a security to the beneficiary with a value of 14 and a basis of 12. Okay? Everyone have the visual? So I'll make EK the beneficiary in this case. I'm the trustee. I owe her $24. Everyone got it? And I'm going to give EK $10, right? And I'm going to give her a security worth 14 with a basis of 12, right? EK, you're happy, right? You get $24 worth of value. Does the trust have income? Well, it has income insofar as we know under the Keenan decision, I'm satisfying an obligation with appreciated property, so that's going to trigger a gain of $2, right? Everyone agree? So the trust has income of $2, and the question, and it's capital gain, right? Capital gain to the trust. And the question is, does D&I include the $2? Does D&I include the $2, right? That's the issue raised in the revenue ruling. And on page 140, if you look at the former regulations, the last full paragraph at the bottom of the last full paragraph, you got to fall within the scope of one of three things. Otherwise, capital gains are not part of D&I. In other words, unless you meet one of these three conditions under the prior regulations, they're not part of D&I. And condition one is allocated to income under the terms of the governing instrument. 2, allocated to corpus and actually distributed, right? There's an actual distribution. Or 3, utilized in determining the amount which is distributed or required to be distributed. And in this case, this is the first year. The first year I'm making a distribution to EK. First year. So I have not established a regular practice of treating capital gains as income, right? Because it's the first year. How can it be a regular practice if it's my first year as trustee? And what you can write in your margins is that under the new regulations, this case is wrong. This is the wrong outcome. Because the fact it's the first year, the new regulations concede, you got to start somewhere, right? How do you get to be a regular practice if you don't start some year in making it a regular practice? So under the new regulations, if Solid decides as trustee that every time I'm going to fulfill my obligation to pay an annuity, I'm going to treat capital gain income as income, then it will be part of D&I. Under the prior regulations, that was not the case. So in this particular case, in this revenue ruling, which is obsolete, this revenue ruling is obsolete for your notes.
How do they put it here?
They put it here just to illustrate it, but keep in mind, in the note that follows, it points out that it's obsolete. So
I guess to make more pages, I don't know.
okay, I get it. That's why I'm trying to write a new textbook. I get it. I get your frustrations. It sounds like Bill Clinton would say, I feel your pain.
If anything can break your brain, this book will.
All right, well, I get it, I get it. That's what, hopefully I stay employed by helping, tell you what's important and what's not. But the authors do, to their credit, on the bottom of page 141, say that it's no longer the rules here. That in this particular context, that if I, as trustee, do establish this as a regular practice, it will work, okay? It will be considered part of D&I. And what the authors do, on page 142, with this technical advice memorandum, and then the private letter ruling that follow, is in the technical advice memorandum on page 142, if you look, keep your finger on 142 and then just turn back a page to 140. If you look at the bottom of page 140, condition 1, allocated to income under the terms of the governing instrument. And here, in page 142, this technical advice memorandum is just to illustrate a case in which the taxpayer meets the first condition, okay? So let me repeat that. You go through this, and it's where the trustee exercises its discretion. And if you look at the bottom of page 143, the last full paragraph on 143, once again, it mentions all three conditions. Mentions all three conditions. And on page 144, if you look at the third and fourth paragraph, Alicia, you'll appreciate this. It references the revenue ruling that you didn't like because it's obsolete. And it points out that in that revenue ruling, none of those three conditions were met. So if you need a quick summary of that revenue ruling, there you go. None of those conditions were met. But it concludes on page 145, in the second full paragraph on page 145, therefore we conclude that the G dollars of gain from the sale of the trust corpus was allocated to income by the trustee pursuant to paragraph 4H of the trust instrument is included in the computation of D&I under 643A3. So this technical advice memorandum is a long-winded way of saying that the trustee allocated capital gains to D&I and did it in a regular fashion, and therefore it was part of the D&I component. So for your notes, this illustrates the first condition being met. All you need is one of three conditions. This is the first condition, and here we have capital gains, part of D&I. On page 145, we have a private letter ruling. And this private letter ruling discusses whether or not the second condition was met, whether or not the capital gains were actually distributed. And what you have here on page 147, the second, third, and fourth paragraph on page 147. The first paragraph, well, how do I say it? The second paragraph on page 147 discusses condition 1. And condition 1, it points out that the governing instrument is silent as to capital gains and the law. So condition 1 is not met of the prior regulations. Condition 1 is not met. The next paragraph, the third paragraph on that page, says condition 3 is not met. Condition 3 is not met. But here, in the fourth paragraph, it says the second condition is met. Because this is a year in which the vast amount of the trust is distributed. If you have a chance to read this private letter ruling, this is where it's many times what will happen is a trust or estate will terminate, but if you're the executor or trustee, what do you typically do? Because you're nervous, because we're all nervous practitioners, is if the trust has, make up a number, $1 million in it, and it's going to terminate, and you're the trustee, what you might decide to do, and picture if you will, I'm going to really oversimplify this. You're the trustee, you have Apple stock that you bought for $100,000, you sold it for $1 million. Okay, everyone have the visual? You're a trustee, you have one stock worth $1 million that you have a basis of 100. Okay, and Young Hung, I'm going to make you the beneficiary, and I just want to make sure as the trustee that nothing comes back to haunt me. So what I'll do is I will distribute to Young Hung $950,000, but I'll keep a $50,000 reserve for a year or two, just in case the IRS or state of New Jersey come knocking. I'll keep a small reserve. Okay, everyone have a visual? And if I keep a small reserve of $50,000, what's the capital gain? Capital gain, right, is $900,000. Everyone agree? Because I sold it and I distributed I distribute 950, but the trust experiences a $900,000 gain. I have to report on the 1041 with the caveat that I distributed out 950.
50 is.
The 50 of capital gain will remain taxable to me because I didn't distribute that out. The other 850 Young Hung will be taxable on because that was distributed out. And that's what this private letter ruling is. That if I distribute out the capital gain, the recipient will be taxed on it, but to the extent I have kept a reserve, to that extent, the capital gain is going to remain. And I have the liquidity to pay. I kept a small reserve.
No, you keep a capital gain and not corpus.
Right.
No.
That's the nature of the whole D&I concept. You don't look at tracing. And generally, again, unless I had a practice of always just treating capital gain as income, and if that was my regular practice, then all 900 would be in young hands capital gain. But if my practice is generally not to treat capital gain as income, but in the year of termination, I would allocate it all out to the extent I didn't retain anything. All that 850 would be considered part of D&I. We're going to go through some problems, okay? So we got a few minutes, but all I'm illustrating, or all this is illustrating, is that condition 2 is met. That the capital gains are actually distributed. You guys can work through the numbers. It's not, this ruling is not a hard one to follow. Okay, this is private letter ruling 8429005. And the final revenue ruling, before we look at these problems, which I want to make sure we get through tonight, is we have a revenue ruling 61-20. 61-20. It talks about NOLs. Okay? When a trust has an NOL, net operating loss, and it carries it back, what is the effect of carrying back an NOL?
Mitigates the tax from previous years.
Say again, David?
Mitigates the tax.
Whose tax?
The trusts from, right?
Or the
Suppose the
decedent.
trust pays out all of its income.
So the recipient, the
How does
beneficiary.
it? Why would it help the recipient? Suppose the trust, picture in year 1 has $100,000 of D&I, in year 2 it has $100,000 of D&I, and in year 3 there's $150,000 NOL. And distributions were made to Shang, right? Because he's the beneficiary of the trust. Year 1, I'm oversimplifying, he would have $100,000 of income. Year 2, he would have $100,000 of income. Year 3, there's an NOL of $150,000. Well, in yesteryear, Code Section 172, NOLs could be carried back 2 years. Under the current, by the way, that's been changed. Now you can only carry forward NOLs. But in years past, you could carry them back 2 years. And if we carried them back 2 years, what would happen if we carried the NOL back 2 years? Well, D&I would disappear, right? In year 2 years ago, the D&I would have disappeared if we carried back that loss. Agreed?
Right.
So Shang would have $100,000. He could file an amended return because now the K1 the trust issued, right, would no longer have $100,000 in taxable income. It would have 0, right? So he could reduce he could file an amended return showing 0 income. And last year, instead of reporting $100,000, he could carry back the $50,000 remaining of loss. So he would have to only report 50 instead of 100. So the NOLs don't go directly to him, but indirectly, right? They have a bearing on D&I. That's the carry. That's this. That's the takeaway of this revenue ruling 61-20. Now, we have 3 problems and then we're going to call it a night. On page 149. says calculate the D&I, net income of problem 2-2, okay? Now if you remember problem 2-2 from last class, everyone remember that? We had $100,000 in gross income, right? We had $300 worth of personal exemption. Should I be drawing? Eraser. Let me start again. Looking for a better magic marker. $100,000 of income, $300 worth of exemption. We have, should be in your notes. The trustees commission and then real estate taxes. If you recall, taxable income began at $83,280, right? Everyone agree? That's what your notes from last class should say, right? So what is D&I? For problem 3-1, guys. What is D&I? What does code section 643 tell us? What do we have to add back here, guys?
Exemptions.
The exemption, right?
And trustee commission.
And what else?
Trustee commission. Yeah?
No.
No?
Take taxable income and we add back exemption. Tax exempt income. All of it?
No, only.
The net amount, right? Okay, the amount less the disallowed expense, so it's $39,420. So our D&I, guys, is 1, 2, 3. Look at that, 1, 2, 3. D&I, everyone's good? All I did was add back the personal exemption, plus, right, Alicia, we got to add back tax exempt income, but it's the net amount of tax exempt income, less the allocable expense. Everyone, this is important. You don't get, now look, if you don't get it tonight, that's okay, but for exam purposes, you've got to get this. Everyone can get this. If I ask this on an exam, I would ask you, what is its tentative taxable income? Tentative taxable income, and this is D&I. (3-2). Assume the same problem in 2-2 also had $200,000 of capital gain. Assume that the gain is allocable to principal under the state law and the governing instrument. Calculate the trust D&I if the trustee distributes only fiduciary accounting income to the beneficiaries. Okay, so let's do this permutation. I need to know D&I in this circumstance. So, does anyone want to venture a guess what it would be? We don't have a number. What do you think D&I would be here if the capital gains were 200,000? What would happen to tentative taxable income, guys? Go up or down or stay the same? Tentative taxable income.
Because it's taxable, you will go up.
To what?
300. Oh, no, no. To 2, by the amount of.
It'd go up to 283, right? Everyone agree? Everyone agree that we would add 200,000 to capital gains? No trick? Everyone agree? the tentative taxable income would go up by 200,000. Agreed? So let's start this. 283, 280 is our tentative taxable income. Okay, help me out under code section 643. What are we going to do about D&I? Are we going to, we know what tentative taxable income is, 283, 280.
Right.
Tell me what we do.
Add back the exemption.
Add back the exemption. Keep going.
You're gonna add back the 39,420.
When you say add back, I don't know if we're adding it back or adding it. It's not an add back. We're adding it to.
Adding to, right.
And what else would we do? What do we do about capital gains?
Take them out.
Take them out,
Yeah.
right? It
Yeah,
doesn't
take 'em out.
643 generally say do not include capital gains, right?
Right.
Guess what? D&I is again 123. Are we surprised by that? How much income is the trust going to probably be paying tax on, guys, here? Make up a number. Make up a guess. How much taxable income will the trust report? Give me an eyeball figure.
200,000 minus 300, right?
$200,000 minus 300, right? It will pay tax on 199,700. Everyone agree? If you had to think about it, the trust is distributing all of its income to the beneficiary, and the capital gain is going to be corpus, right? So it recognizes the $300,000, right? Or what's the capital gain? 200,000, excuse me. It gets the exemption. And that's it. Game over. All right? Everyone got this. And if you don't, you'll get more. But, you know, let's just, we're good? Everyone see that? And I should, for your notes, by the way, I apologize. I should make this a minus, right? Because we subtract out the capital gains, right? Everyone agree? That's what 643 tells us to do. Question B. Calculate the trustee and I if the trustee distributes not only fiduciary accounting income, but $200,000 of principal to the beneficiary. Okay? Will that change the outcome?
No.
No, right?
Yeah.
If in question B, it says if the fiduciary distributes not only accounting income but decides to make a principal distribution, that doesn't change the D&I, and that's this, just for your notes, that's what revenue ruling 68-392, Alicia, that's the revenue ruling on page 142, that's what that says. And even under the new regulations, this outcome wouldn't change. The D&I remains constant, right? The D&I remains constant. This is what, you remember how in Manufacturers Hanover, they talked about D&I being static? This is static. It's going to stay the same. So under the regulations of 643A-3, I'll repeat 643A, that's where I was reading, right, Alicia, when you were trying to find the regulations? This is the same regulations that this would not change the outcome. This would not change the outcome. So final question, but the most important question. So question B is the same as A. The recipient in problem B is going to be taxable, you know, up to the amount of D&I, but the $200,000 corpus distribution, right, should not be taxed. But here, it says calculate D&I, question C, the trustee distributes not only fiduciary accounting income, but also $200,000 of principal, right, to the beneficiaries. And thereafter, only $50,000 of principal remains in the trust. Sound familiar?
Yeah, this was your example before.
This was my example before. So D&I is going to include how much of capital gains? How much of the capital?
Capital gains are 200.
Will it include all 200? It's going to include 150, right? The capital gains, 150 of the capital gains will be deemed to have been distributed, right? Because here, the trust kept a $50,000 reserve, right? Everyone agree? The trust kept a $50,000 reserve.
But I'm confused here because it says principal. Why am I?
It says only $50,000 of principal, but remember, in this context, labels may be misleading because the trust or the trustee can call whatever he or she wants, but the $50,000 that remains, remember, even the capital gain income, isn't it being transformed if it's being held into principal? Isn't the capital gains, if it's being held by the trustee, transformed into corpus? Think about, we don't have time to debate this because I want to illustrate the problem, but hold that thought, David. We're going to begin next class by further discussion.
Right.
Go with me on this, okay? That pursuant to the last private letter ruling that we just looked at, that 150,000 now will be considered part of income. 150,000 of capital gain will be considered income.
Okay.
So now the question is, how does that change what we've done here? Now, bear in mind, if you don't mind me saying, that let me see if I can find one more board here. If I can. There's the ratio that I was looking for, but that doesn't matter. If you go back to the original problem, you have 50,000 of dividends. You have $30,000 of Chrysler. What was Chrysler? Was that, what kind of income was that?
Interest income from the bonds?
Taxable interest. Chrysler gave rise to $30,000 of interest.
Mm-hmm.
New York City,
Excluded.
0. Rent of 20. And we had 200,000 of long-term capital gain. Just go with me on this for a second. So our gross income here is $300,000, right, guys? I did my arithmetic right. $300,000 of gross income. Okay? And now we have an exemption of $300, right? We have $300,000 of income less $300 personal exemption. We have, now here comes the tricky part. What were the trustees' fees? $2,000 before. Everyone agree?
Right.
Okay? If you recall from the original problem that we did 2 weeks ago, what was the numerator? To figure out the disallowance provision, what was the numerator?
40.
40. Over 140. Okay? But is that the case anymore? We use 140, right? Because we didn't include capital gains, right, Alicia? Manufacturers Hanover. But now, everyone understand, under Manufacturers Hanover, we did not include capital gains. But now 150,000 of the capital gains is considered income. Guess what? Our denominator, right, will grow by 150,000. So it was 140, but now because 150, right, is now considered income, it will enter into the denominator. And as such, our denominator is larger, and this is only 14%. okay, disallowance. So now, under this, 280 is going to be disallowed, applicable to tax exempt, and 1720 will be allowed. Everyone see that the lost disallowance is going to become smaller. So the trustee fee here, is 1720. That's 2,000, right? Less the amount applicable to the tax exempt. Minus 15,000 of taxes. So the tentative taxable income is 282,980. The tentative taxable income is 282,980. Okay, what's D&I here, guys? We're coming to the finale. This one everyone here should get. Now that we figured out tentative taxable income, and again, this is the trustee fee. What's D&I?
Add back 300.
Add back 300. Beautiful. What else do we do?
Tax exempt income.
How much tax exempt? The net amount we got to add back to figure out D&I, which is the 39. Oops, yes, 720 because 720, which is the tax exempt. This is the personal exemption. And then what do we subtract out?
Do we subtract out
Capital gains of how much? No, we subtract out that part which is not considered income, only 50. We subtract out that part of D&I which is not. Only 50,000 is not. The other 150 is considered part of D&I, right? So what's our D&I? 273 is our D&I, which makes sense, guys, because when you think about it, what was our D&I without the capital gain? 123, right? Everyone agree? But now we learned that we're distributing out 150 of capital gain. What's 123 plus 150? 273, right?
Next class, can you show us of the number how you came up with the 50 remaining? Because I need to see what the numbers like.
That is the amount that's remaining in the hands of the trustee. Okay, the 50. That's the only amount left, but that number constitutes the capital gain in the hands of the trustee. The trustee is going to remain taxable on $50,000. The trustee is going to remain taxable on $50,000 because that's what they're holding back.
How?
Well, think about it because I know you guys have been gracious enough.
I just don't like the idea that I just don't like it. Okay, I have to think.
All right, you got to think about it. Look, I appreciate, for those who can make it here on a Friday night, appreciate those watching on the videotape. Have a great weekend or whenever you're watching this. And I will not see anyone on Wednesday this upcoming week. I will see everyone a week from this Wednesday. And if you can, good news is that we are not going to have as much reading as we normally do. We're going to only read, and this should not be too burdensome. So everyone should come well prepared. Only to page 178. How's that? Music to everyone's ears. All right? But if you can, make sure if you haven't read for today's material that you catch up and then read ahead for the next class. And I will distribute out, for those who are here, if you want to take one, I'll bring these back up to my room. But if you can, take one of these, and those who aren't here, I will distribute out these, and we will start looking at some 1041s. And that will hopefully give you the ability to sleep at night, okay? So everyone, again, have a good night, and if you turn off the video, I won't feel on stage. Sure.